Hello everybody. Had to do a quick plug-in there. Welcome to the Thursday Financial Thing live stream. Hope you're doing really well. I went live a little bit early, half a minute, not half an hour. Hope you're all doing well. Thank you for joining. Unfortunately, we're supposed to have an Arinda from Cufflink here this evening, but he had to reschedule. It happens. Wouldn't be the first time, so you are going to get a session with me tonight. Hopefully that will be rescheduled. I would imagine sometime, I would think September. We have Peter Reed from Assets Exchange on the 29th, so likely Narendra will be here probably early next month, hopefully with his schedule. He's a family man, 7:30 at night. I get it. It's tricky. But anyway, I'm here. So hopefully that's good for you. If not, sorry, what can I say? Speaking of Cufflink, they are the sponsor of this stream. Here we go. You know what the deal is. You can get up to 10.25% gross interest per year. They've got way north of 330 million pounds of invested money since 2016, and so far zero investor losses to date, so they claim. Capital is at risk. Please don't invest unless you're prepared to lose money. Please check rates on Cufflink's websites as rates do change. You can sign up at join.cufflink.com/financial-thing. Link is in the description below. As always, thank you to Cufflink for sponsoring this very fine 59 minutes or however long we go for this evening of investing, peer-to-peer lending. So what are we going to look at? You know, whenever it's a slow week of peer-to-peer news, as is this week, I usually try to find something interesting to fill the time. And this week is no different. We're going to look at some old papers that I found while doing some clearing up, which are very interesting to me. I hope they will be interesting for you. It relates to investing, of course. So, quick hi to everybody in the stream. Steve Thomas is here from a very wet Macclesfield. Peter Vincent Leatherhead. Colin Perry is always in the Peak District. Dave Dawson is here. And Stephen Hale in a dull Nottingham. Sorry to hear that. Sorry it's dull. But I hope it's not too dull where you are. I'm sure it probably is. Chat. We're going to take a look at the trading 212 portfolio as this very bipolar financial markets still continue to rule. So what's going on in the trading 212 portfolio? We'll look at that. Hi Paul in Kenilworth. And hi Paul in Stockport. Two Pauls. One after another in the chat. But if you have any comments, interesting thoughts, things you want to know about, put it in the chat and we'll talk about it. It's very informal this evening. Very informal. So let's get right into it. Here we go. On the Alternative Credit Investors website has a story about LendInvest chief receives no bonus or pay rise after the lender falls into the red. LendInvest chief Rod Lockhart receives no bonus after it was reported that LendInvest had a challenging year and took a £27.3 million loss on their 2024 reports, their annual report, which is the period ending on the 31st of March 2024. Lockhart's total remuneration for the year was £418,000, flat from the previous year. Not too shabby, I would say. But it seems like LendInvest had a bit of an accounting snafu. It says the stagnant remuneration of the boss man's salary figures follow a tough year for the specialist mortgage lender. Amid wider property market challenges, it reported a pre-tax loss, $27.3 million in its latest annual results, down from $14.3 million profit the previous year. So that is, what is that, a £40 million swing. That's no fun for a company to experience. In June, LendInvest was forced to lower its full-year profit guidance ahead of results announced due to an accounting discrepancy relating to the sale of its securitized loans. The specialist mortgage lender announced on the 5th of Jan it would earn $12.1 million from the sale of its interest in Mortimer Buy-to-Let 2023-1, a securitization of buy-to-let mortgages. However, it later reported an issue related to swap and hedge accounting assumptions that include, who cares? You know, they made an accounting mistake, and instead of posting big profits, they posted big losses. And you know what? I'm all in favor of the boss man not getting a bump in salary. I think a lot of CEOs, their pay should be related to how well they do or how well the company does. You know, you hear about these major blue chip publicly held companies where these CEOs are taking massive salaries, yet the stocks are doing really badly, or the company's taking losses, yet those bosses seem to still get massive salaries. What kind of bonus? I think that your salary should be related to how well the performance is. Probably with politicians too, but that's another story. Let's crack on. Bondora originates a record 32.8 million euros. Look at that. The biggest peer-to-peer lender in Europe seems to be doing really well. They've reported a record 32.8 million euros. That's 28 million pounds worth of loan originations just in June alone. Can you get your head around that? I mean, you know, some of the peer-to-peer lending companies in the UK are originating 10, 20, 30 million a year. And this company, Bondora, is originating 28 million just in one single month. So apparently a lot of people need to borrow money. That's record-breaking for them. They've celebrated a 1 billion euro investment milestone in July and raised their investment limit for investors. Lending in the Netherlands saw 51% growth. And in Finland, big amounts being lent. 20.3 million euros. Latvia, 223,000 euros. Estonia, 5.7 million euros in loans. So obviously, people love credit, they love debt, and Bondora is the happy recipient of being able to originate loans on their aggregation system that they have over there. So if you are a Bondora investment or investor, you're probably going to be doing pretty well. Yes, personally, I don't invest through Bondora, but I can understand why people do, especially people residing in the EU. Investment fund heralds peer-to-peer fixed income-like returns amid market volatility. Peer-to-peer lending offers returns comparable to traditional fixed income and can provide diversity amid volatile public markets, investment fund has said. It has been a turbulent summer for global markets, partly due to weak U.S. jobs data and concerns around tech valuations. Investment fund conceded that peer-to-peer lending is still exposed to massive movements in financial markets. Of course, risk. Got to take risk if you want to get that interest. And these movements in financial markets impact the wider economy. But added, when it's raining, everyone gets wet. But there are those with the umbrellas of diversification to shield themselves from the worst of it. I like that analogy. Listen to that. Again, when it's raining, everyone gets wet. But there are those with the umbrellas of diversification to shield themselves from the worst of it. The firm suggested that investors look for fixed returns over a mixed-term horizons may not have their requirements met by equities, aka Mr. Stock Market, alone. In a blog that's packed with old adages this week, time in the market often beats timing the market. But nobody knows in equities what a successful time frame will be. If you want a return comparable to fixed income, want to control what the time in the market looks like, the peer-to-peer lending asset class offers those solutions and returns with the same tax-efficient compound effect on multi-year diversified investments. So a little bit to unpack in there. Well, I don't think that's strictly true that nobody knows in equities what a successful timeline will be. I mean, you could look back at history and say that if you invest for a long period of time in equities and stocks, you're probably going to do pretty well, depending if you what products you pick. But I am starting to feel like peer-to-peer lending is a very snoozy sector at the moment, meaning that I haven't really had to worry too much about keeping an eye on it like I have in the past. It's more like a set and forget type system where you do have to kind of keep your eye on what these companies are doing. But for the most part, things seem very quiet, especially with the solid companies out there and the auto invest products, so you don't have to do self-select. It seems like a pretty just stable fixed income product. Of course, it's not like a traditional fixed income product. It's not like a bond, but it kind of feels a little bit more stable to me now than it has in the past. So I would say peer-to-peer lending heading in the right direction. Again, it all comes down to how much risk you're really willing to take, what you're comfortable with, what can you sleep at night knowing what your percent of your net worth you have in any given sector. Peer-to-peer lending is one of them. It's funny, peer-to-peer is one of those places where if somebody said to me, I've got 75% of my entire net worth invested in peer-to-peer, I'd probably feel a little bit red flaggy about that. Personally, myself, I don't feel comfortable enough to have that high of a net worth invested into these companies because, at the end of the day, like as I always say, hate to hammer this point, but one CEO of a very prominent peer-to-peer lending company told me any of these companies could go bust at any time. All it takes is one black swan event or somebody makes a mistake with the loans, blah, blah, blah. And he even said that about his own company, which I consider one of the most stable out there. So I'll never forget that fact that he told me that. And I always keep that in the back of my mind. So diversification is key. And you really have to figure out what you're comfortable with and what you're okay sleeping at night knowing how much money you have invested in a sector. I don't worry too much about stocks so much, especially index trackers, because I know that not all of those companies are going to go bust. 1,000 companies are not going to go bankrupt. So not too much to worry there. But a single peer-to-peer lending company could go bankrupt. And that therein lies the risk. It's something that we just have to be aware of. Moving on. I found a very, very interesting website, which I highly recommend you go check out, especially if you're interested in investing in stocks and whatnot. This place is called Dataroma, DATAROMA.com. I'll put it in the link in the description after the stream is over. But this is a really cool place where you can go and look at the portfolio updates of very big funds and investors and see what they're invested in. Usually it's a little bit delayed because these guys don't have to report. It's true, when they make a trade, they don't have to report to the SEC or to the powers that be. It can come a few weeks later or a couple of months later. But nonetheless, it's really great to be able to go in and check out what people's portfolios are. I mean, we got people like Bill and Melinda Gates Foundation on here, Warren Buffett, Carl Icahn, big players in the investment world. Michael Berry, of course, who from The Big Short, the guy that shorted all the mortgage-backed securities back in the crash 2008. A lot of big names here, and it's really cool. If you, for instance, we take a look at Warren Buffett. It's going to show you exactly what his portfolio is and the date. So here, 30th of June, 2024. So every quarter they have to report what they're holding, what they've changed, and this website aggregates it. It's really cool. So you can see here, Warren Buffett's portfolio. I mean, get your head around this. 279. That is billion. 279, just a short hair under 280 billion US dollars of stocks in this guy's portfolio. You can see majority here in Apple, which, by the way, he reduced by 49.3%. So he sold a ton of Apple stock. And then lost 6% on the upside because he sold too early, but of course he doesn't know. But you can see here how many shares he has in any given stock, what the value is, what the reported price, what the current price is, and how much plus or minus the price has gone up since this report was made in Q2 of 2024. So you got huge holding in Apple, 84 billion US dollars. Bank of America. I mean, this guy goes for the blue chips, right? Bank of America, American Express, Coca-Cola, Chevron, Heinz, Chubb, a security company. We got Citigroup, banking, Visa, credit cards, Amazon.com. The list goes on. He's got 41 stocks in the portfolio. Some of them are smaller holding, 8 million in the Atlanta Braves, the Major League Baseball team holding company. Even look at this. He's even got himself an index tracker in the form of SPY, which is the Spider ETF Trust, 21.4 million US dollars. But yeah, go check out that Data Roamer. It's a very interesting one. I thought one of the other interesting portfolios here is Michael Berry's. Of course, the big short guy. He has 21% of his portfolio in Alibaba, a stock I too used to think was maybe the way to go, but being that is a Chinese stock, I'm not so confident that the Chinese government is just going to take that company away one day. And that stock hasn't really moved either. I think we sold out 85 US dollars, and now this thing is still only at 79 US, so it's not really done well, and they've had a good report of earnings too recently. But yeah, you can see JD.com, a lot of companies I've never heard of before, so he's obviously going for the high risk, high reward plays. 52 million US dollars, only 10 stocks, so high octane, but he's known for shorting a lot of stocks. What else? We got anything? Let's see what the Bill and Melinda Gates Foundation Trust is holding. Well, can you imagine the top of the list, Microsoft? Then they got Berkshire Hathaway, so that makes up just those two stocks 53%. Waste Management, Caterpillar, Walmart, Coca-Cola, FedEx. So just a bunch of blue chip stocks making up the majority of this 47 billion US dollar portfolio. What else? Madison Square Garden Sports Corporation, Anheuser-Busch, InBev, Heinz. Yeah, so the list goes on. But go check that out. It's dataroma.com. And you can go get all this information absolutely free. Let's see what else I bookmarked here. Yeah, for everybody that's thinking the economy is doing really well, one company is not doing so good, and that is Nissan. It says Nissan dealers are not having a great year so far. Profits have nosedived by a mind-boggling 70% compared to last year, forcing the closures of 8 stores, and nearly 40% of its U.S. dealerships bleed red ink. Why is that happening? A mismatch between price and product is slowing down sales. They don't have a hybrid version. I think they have a Nissan Leaf here in the U.S., but competitors like Toyota and Honda are really leaving them in the dirt. So you may not see Nissan around if they don't continue to innovate. They may be really struggling. Inflation, we're having a good week on the stock market. Inflation is finally in the USA reportedly, and I say reportedly because I think these numbers are fluffed. I don't think inflation is at 3% because people are always telling me how much their rent has gone up in the last year, usually 10%. But anyway, this shows inflation 2.9% from last year, year on year. Very, very happy stock market people out there because you can see the numbers that have come down from 9.1% at its high point in June 2022. So 2 years ago, we've had these massive interest rate increases that have really been set to curb inflation. So it has done. We had a small spike here back to 3.7% from 3% in June 2023. Now back down to the lowest point in 3 years. Why do you care? Because this kind of information makes the stock market salivate, and is obviously pointing to a interest rate cut from the U.S. federal government, which will have ripples through the economy in the U.S. and through the world, including the U.K. I expect the U.K. stock market to do very well once the U.S. Fed cuts their interest rates I'm thinking should be next month. We'll see. But piece of good economic news. Trading 212 portfolio. We're going quickly today. By the way, I don't plan on being here for 59 minutes today. So check out the portfolio. We've had a big run this week. 21,661 pounds. So we were down. You can see here. We were down. If we look at just the last 1 month. Our low point was. So 24,000 total, I believe. We were getting close to 23,000. So in the last month, I think, what was it, 18? We were at 18.5. And now we're back up to 21,648. What's been doing well? Advanced Micro Devices has finally had a bit of a run. We were in the red. I think we're about 8% difference on that. Coinbase is starting to rebound. Creative Realities is still just bouncing around. If you're a day trader, which I am not, if you're a day trader, this would be a kind of stock that you would look at actually trading because of those volatile ups and downs that this stock seems to have every day. 411 up to 442 and then back down to 408. So you can make some money trading a stock like that, which I do not do. I don't recommend, but some people out there are going to do stuff like that. But that's 16% in the green. NVIDIA is bouncing back now, 25% in the green. Of course, look at those low points. You could have got yourself some NVIDIA stock at 93. Now you're at 122. That's a big bump. Falco Energy continues to bounce back too from its low, about 587. And then the Vanguard S&P 500 ETF has put us 3.46% in the green. So less cash now in the trading 212 portfolio. We're sitting on 4,807. So majority now the money, about 28% is in cash. So a good time, I think, to be invested. This is not necessarily the time to sit in cash. So the portfolio doing well. Hoping to get it back over that 24,000 pound range so we can give some more money to charity. That's the reason why I started this this trading 212 portfolio. Good advice here. If you try to time the stock market, you'll do horrible long term. If you're afraid to invest in the stock market, you will do horrible long term. If you just consistently buy and hold, you will do incredibly long term. Don't get fancy. I think this is really, really great advice. And we're going to have a little bit of story time here, so bear with me. I've been reading a book recently called The Magical Art, The Magical Life-Changing... What is it? Hold on, let me look it up. Magical... The Life-Changing... Here we go. The Life-Changing Magic of Tidying Up by Marie Kondo. If you haven't read that book, I highly suggest you read it. It's a great book. It's a great book for many, many different reasons. I'll show you the cover here. Hold on. There it is right there. See if we can pull it up on Amazon. The Life-Changing Magic of Tidying Up. It's a beautiful book. Somebody told me about it. I went to their house one day and everything was in order and there was not stuff everywhere. And I got kind of tired of seeing bits and pieces everywhere where I lived. And I thought, I'm going to start taking the lessons from this book and getting rid of things like papers, things that have been sitting on a shelf collecting dust. And basically what it says in the book is if something doesn't bring you joy, you discard it or donate it, thank it for its service, old clothes, things like that, hats, jackets, blah, 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 things sitting on your mantelpiece. And I started really following this. And last week I had a bunch of boxes of tax paperwork from dating back, I don't know, 2012. And it was just stacks of receipts, tax filing papers from the UK. And I started going through some old stock papers that I'd found. I don't even know why I had these things. I guess they were part of the tax filings from years and years ago. And I found some really interesting things, and I wanted to show it to you. A little bit of context. Back in 2005, I believe, when I started to make a little bit of money as a young guy I was trying to think about the future. Nobody ever taught me how to invest. My dad always preached save, save, save. But he was more of the saving guy where you put some money in your piggy bank, save cash, right? But I had always thought there's got to be a better way than that. So I was working at the time with a ex-business partner on a real estate and property business. And I was in an office of a very, very successful lawyer. And we were doing some things with this lawyer. He was probably one of the most successful people that I knew. And I asked him, I said, Mark, I want to start investing for the long term, but I don't know how to do it. What would you recommend? He goes, well, I have this great financial advisor. His name's Sammy, right? And Sammy has been my financial advisor for ages, and he takes really good care of me. And I thought, well, this guy Mark's successful. So the guy who's investing and taking care of him must be successful. And I didn't have a lot of money at that time, but I wanted to get started. And I thought, if I could put away a couple of £100 here and there, a couple of $100 here and there, I could start to really save for my future because nobody was teaching me how to do it. So I went for a meeting with this guy. He was dressed in the really nice three-piece suit. And he talked a really good game. He was very articulate, very charismatic, had a nice BMW, the 7 Series. And I sat across from him and I said, look, I don't know how to invest. The only thing I've ever done in investing is bought some BP shares when I was young that my dad gave to me. I didn't even buy them. They were the 25p issued BP shares, and I had some Shell things that my dad given me. There was nothing really. I had no experience. And I told him that. And he said, Lawrence, don't worry, I'll take care of you. He had a very thick foreign accent. He said, don't worry, I'll take care of you like I would take care of Mark, the lawyer. So I signed up, and I got an account. And then he's sending me these statements. I don't really know what any of these investments are, nor did I bother to do any research and find out what the investments were. I just trusted this guy. I trusted him. And I think come about 2008 or maybe a year and a half, 18 months later, I started to pay attention to these statements he was sending me, and I noticed that the unrealized loss and gain of the investments he had put me in were not really changing. I compared an old statement to when I first started investing through him to one that had come through 18 months later, and not much had moved. Of course, this was a time period when things were not going well in the stock market. I think right before the crash of 2008 was when I decided, you know what, this guy's not doing that great. I'm going to try to find an alternative, which I did. But when I was going through my paperwork recently, I found some of these statements from 2007. And I wanted to show you them because I started doing a little bit of research. And I know I always preach about doing your own investing, but this is really for people out there who do put their trust in financial advisors. This guy had been a financial advisor for a long time. He worked for a good company called New England Securities here in the U.S., but I just wanted to show you this because I want to show you what kind of stuff that he put me into and some of the bad things that I found out later on while doing my research when I became, should I use the word woke? I hate that word, but financially awakened. So you can see here, this is the statement period of May the 5th. It's backwards in U.S. dates. 2007. I had to scan this. Of course, everything was in paper format back then. But down here, you'll see there's things called mutual funds, which in the U.S. is basically an index fund or a tracker. It's not a tracker, but I don't even know what they call them in unit trusts, I think, in the U.K. So he had me in these 3 companies down here. AIM, Small Cap Equity Fund Class B, AIM, European Growth Fund Class B, and AIM, Asia Pacific Growth Fund Class B. Now, AIM now is Invesco, so I'm sure you've heard of Invesco. They switched over to that. I don't know if they changed their name or they bought out AIM. But these are 3 funds, and they sounded really great on paper. And I want you to look at, I'm going to just take you through these 3 things that this guy put me into. So the first one was this AIM Small Cap Equity Fund, which was a price of $11.82 in US dollars. And I think this was back in 2007. So now we're talking about, 18 years? Is that right, if my math's correct? I don't know. Yeah, 17 years ago. 17 years ago. Long time ago. This is the fund. Looks pretty on paper, right? Small cap equity. So it has things like healthcare, home builders, technology. It's more of a juiced up portfolio. It has about 903 million in the fund. So pretty small nowadays for funds, but back then these kind of funds were popular. These were the things that financial advisors were pushing to people like me, people who didn't know any better. So I wanted to take a look at this fund and see where we were. Remember, we paid, or on paper, this statement date, I don't know what was paid for this fund, but it was 11.82. So that was the unit cost. And now, today, this is the equivalent fund. I want to show you this. Invesco Small Cap Equity Fund. This is the same fund now in a different name. Years later. Today we're at a price of 14.39 US dollars. But what I wanted you to pay attention to is these other things down here, which is turnover of 43%. Okay, what that means is this fund is turning over the stocks. On average, they're turning over almost half of the stocks every year. It means buying and selling. They're actively buying and selling, causing all kinds of tax issues. Because when you buy and sell, you got to pay capital gains tax, harvesting losses, blah, blah, blah. So 43% of this fund is being bought and sold over the period of a year. Also, that creates trading fees. Those tax and trading fees get passed on to you as an investor. But over here, this is what really made me sick. This front load in the US, and this happens to in the UK, but this is a fee that when you first enter the fund, you pay. So 5.5% is the fee. Basically, some of that fee goes to the financial advisor, and most of it is just fluff expenses and that you are paying out. So if you invest £10,000 or $10,000, you're going to pay $550 in fees off the back. So you're already in minus 5.5%. Not only that, you got a total expense fee of 1.26% a year. That is not including what you're going to have to pay your financial advisor, his fee too, which is likely another 1% on top. So right now you're already 7.7% in the minus. Now you can see here total assets of this fund today are only 601 million, which is a very small blip because look at these fees. Who's going to pay 5.5% now to get into a fund? But yet, saying that, there is still 600 million US dollars in this fund of people who do not know any better, of people who are being advised by these financial advisors to go into these types of funds, even that still exist today. Some of them don't, by the way. Some of them don't even make it this far. Right? And the worst part about it is the returns. So we do the math, 11.82 up to 14.39. So we had a 21% return over 14 years. Get your head around that. We didn't even make, if we'd have bought and hold and listened to this advisor, you'd have been making less than 2% a year on this fund. Now that does not include dividends or anything like that, but this is a terrible, terrible rate of return. Next one, AIM European Growth Fund Class B. This is another one that you can take a look at the numbers. And of course, this goes to show why this is the Invesco European Equity Fund. It's a similar fund. Front-loaded again, 5.5%. So again, the financial advisor took his nice juicy cut on the fees. 17% turnover. It's only got a 1.37% dividend yield, so not much going on in the yield department, so you're not getting a great dividend. And total expense ratio even higher on this one, 1.42%. What was the returns on this one? We would have actually lost money. This one is 37.6 US dollars today, And when this fund was purchased, you see down here, 39, see right here, 39.64 US dollars. So we'd have bought and hold, which is always the best strategy, you think. This is the problem with buying actively managed funds. So we would have been minus 5.1% over 14 years. So it made absolutely nothing and actually lost money. That's not good. This is the professional advisor. Lastly, AIM Asia Pacific Growth Fund. Sounds great, right? We paid 23.84 US dollars, so 23 US dollars and 84 cents. Another one that has another fat front load fee of 5.5%. Look, there's still 290 million US dollars of people's money sat in this garbage of a fund. Expense ratio, another 1.45% a year. A nice front load fee. Terrible dividend yield. So dividend 0.93%. Turnover 16%. Look at this. Team managed. So it's been managed by people that are making a lot of money off of, unbeknownst to really just amateur investors like me when I was back then. I didn't know any better. So we would have made, if we'd have just bought and hold this fund that this guy put me into, 14.3% over 17 years. So about 2% a year. No, sorry, not 2%. 1%, 1.1, less than 1.1% a year from that increase of that price in that fund. So it's not looking very well. Now here's something that I did myself. I found this statement of a brokerage account that I opened up just a few, I think this was right before I went to this advisor, because I had a TD Ameritrade account, which in the US is, it's kind of like a Charles Stanley. But you can see here the statement date was December 30th, 2006. So I believe I switched over to this guy in mid, quarter two of 2007, because I was doing it on my own. I had made an attempt to invest something, and I didn't know what I was doing, quite honestly, but I tried. And then I decided, well, if I don't know what I'm doing, I'd rather have a professional take care of it. You can see here, hopefully you can see this at the bottom of the screen. If not, sorry, I apologize, but security positions, can you see that? I hope you can. I'll read it out to you. I had this stock called AT&T Latin America. It was a penny. It was a junk stock. I had eBay, 228 eBay shares, 60 Electronic Arts shares, which are a video game company, entertainment company, and then 147 international gaming technology shares. And I compared how those things are done compared to, obviously, what this guy had put me into. We'll take a look at that. Well, now the AT&T Latin America stock, which basically got delisted because it was crap, that one, I think, went to zero. But I didn't have a lot of money in that. I had 16 shares, nothing. eBay. Now we're sitting at $56.33 is the price of eBay today. This was, again, 2006, 2007. 78.07% increase from what I paid, 31% up to $56. Sorry, $31 to $56. It was a 78% increase. Now, this is me not knowing anything about investing, just blind. Next on the list, Electronic Arts, which you have 60. Today, the price of that stock is $146.49. We paid $48.22, and that's a gain of 206% if we'd have bought and hold for 14 years. Not bad, right? We also had a loser, so out of the three stocks that I was holding right here, actually there's four, there's one more I'll show you in a minute. International Gaming Technology, they make slot machines. And I thought, slot machines, that's a great business, right? They were the big time player in the slot machine business. Every time you go into a casino, everywhere I've been in the world had IGT slot machines. I thought, wow, what a great investment. I paid $45 $21.35 for this stock. Today, $21.86. We had a big loser there. This is the problem with trying to pick out stocks. Down 51% on that stock. This is why you cannot put all your eggs into one basket when you're picking out stocks. Fourthly, we had QQQ. Look at this. Technology, QQQ. It's the NASDAQ 100 share index. It's like the spider. You own a bit of everything. $43.57. Now that's price you can imagine a lot higher. 474 US dollars. Wow, what an increase. Huh? 986%. So if I had just bought and held that, I mean, how many did I have? 128. 474. So that's $47,400. What a mistake. Yeah. But what is the point of all of this? If I'd have just taken the VTI, which is the standardized, basically it's an ETF, an exchange-traded fund of the Vanguard US equity market index tracker that I tout so much, right? If I had just bought that and held it from 2007, in May 2007 to now, the increase would have been 270%. And I wouldn't have had to worry about dealing with financial advisors hitting me with this ridiculous fees, these front loads that I didn't know to ask about. I had no idea what the front load was. I didn't know that I was paying 5.5% of all my money just to get into this investment. So these fund managers could be paid these large salaries. And so, this guy, Sam, from New England Securities, that's where he makes his money. Look, people got to get paid, I understand. But there's a thing called fiduciary responsibility when it comes to financial advisors. Was he putting me into these funds because he's getting a nice front load fee on the front end, or was it because he thought these were good investments? That's the problem. I don't know. I mean, the investments obviously didn't do very well over the long term, so that makes me believe that he was acting in a non-fiduciary way towards me as a customer, putting me in funds where he could get a piece of this front load fee, and he would continue to collect this fee. It wouldn't be 5.5%, but every year he gets a nice little dividend off of this fund who's going to pay him to keep me in it every year. Not good. That's not good at all. If I'd have just stuck into this VTI or even the QQQs, if I wanted that much risk, that's to me is a little bit too high risk. I mean, look at the .com bubble in 2000. If you'd have been holding something like this, you'd probably be feeling pretty sick if this was your only investment. Whereas I think VTI or the index trackers that we would talk about is the absolute way to go. You don't have to worry about that high volatility. If the tech market crashes, you've got healthcare in here, right? If healthcare crashes, you've got oil in here. If oil crashes, you've got banking in here. It's a beautiful thing. It's an absolutely beautiful thing. That guy didn't do me any favors, and this is why I always really preach this hard to people, and they don't understand. There's just a certain aura that comes along with financial advisors. People think that they're super well trained. They're always acting in your best behalf. And this is why I preach you have to know what it is that people are investing you into. Even if you do hire a professional, for some people I get it. Some people have to have that push to get started. And I do thank at least my guy for getting me started, right? Allowing me to have something invested in the markets. We did make a little bit of money. Thank God, we didn't hang on to this long term because there was some profit made there. But thank God I had the foresightedness just to look at it at least after 18 months to say, this is not working, because these numbers were not moving. In fact, I think they went backwards. But this is why if you do use a financial advisor, you need to understand what it is that these advisors are putting you into. Do that research. If I hadn't researched these, I wouldn't have known there was a 5% fee just to enter the fund and a 1.42% fee for being in the fund every year. Whereas VTI, my index trackers have got 0.03% fees. They're so small. That's money that's in your pocket. That's better returns. You have to look at this stuff. So, point is, if you do use a financial advisor, please do yourself a favor. Do some research into what they have invested you into. Ask them why they don't put you in an index tracker. Ask them why. They're going to tell you because managed funds are better. Managed funds are better. It's better to have somebody trading, right? Look, the managers, Hartsfield and Paddock. It's better to have these guys, Mr. Hartsfield and Mr. Paddock, in there trading 43% of the entire fund over and over and over again throughout the year to get you a better return. But yet this is trailed, for the most part, the returns of just buying an index tracker and buying the whole market. If we look at all of the entire chart for this Invesco small cap equity, this was in 2000, right? $9.35, it's only $14, so it just hasn't done really that well, and that's with the professionals taking care of it. So you need to know what you're invested in. Anyway, that's my story time for you today. Hope you enjoyed it. A little bit of other news. Goldman Sachs and Morgan Stanley have both taken stakes in Bitcoin ETFs in Q2. This is quite big news, I think, people. August 14th, this was reported. We have Goldman Sachs. They've gotten themselves $418 million worth of the recently launched Bitcoin ETF. And then Morgan Stanley has also got himself some BlackRock iShares Bitcoin ETF, 5.5 million shares worth about $188 million. So these big guys are getting their claws into these ETFs, which, if this isn't bullish news for Bitcoin, I don't know what is. I think it is. It's very bullish. Anyway, that's what I got for you today. Not going to keep on talking just to talk. We're going to keep it sweet and short. See if you have any interesting messages here. Mike is here. Hi, Mike Powell. Hello, Annabelle in Sussex, back in the UK. Alan Stratford, you're late. Your punishment will be 5 minutes in the corner of the room. 5 years is a good time frame. I agree. If you want to invest in the stocks, you got to leave them for 5 years. Yes. Front load of 5.5%. Disgusting. Annabelle has had not my fingers burned, but the whole hand bitten off to the tune of horrifying amounts from financial advice. I totally agree. Be very careful. Check your statements with a fine-tooth comb. And Peter Vince has a similar experience being recommended to a managed fund by a big UK name. Front loading for mine was 3%. You got away lucky, Peter. 3% is not as bad as 5.5%. There are some front loads that I've seen as high as 10%. So it's really interesting, though, to pull out old statements like that. I'm kind of glad that I had them, because I know I made the right moves, becoming educated, learning how to invest in index trackers, and diversifying into peer-to-peer lending, other things too. Diversification is the answer. I'm going to get out of here early today. My goal has been actually to try and make the stream a little bit shorter as the weeks do come, because we do have less news, I think, especially peer-to-peer related, so I don't want to sit here waffling around for no reason. So I'm going to get out of here. Go enjoy your weekend. Hopefully the sun will come out. I'll be back next Thursday, all being well, and I appreciate you guys being here. It's always good to be here. That's all I got for you, so I'll see you next week. Take care. Bye.